Welcome back to Cheryl Trades Leaps. Most investors believe market crashes happen because of fear and bad news. But sometimes markets fall much faster than expected because of something happening behind the scenes in the options market. Today, we're going to explore one of the most important mechanisms that can accelerate market crashes, something called a negative gamma environment. And more importantly, we'll talk about why these moments can sometimes create rare opportunities for long-term leaps investors. 1. Why markets sometimes fall so fast. When markets suddenly drop, it often feels like everyone is panicking at the same time. Fear and negative news definitely play a role. But part of the reason markets can fall so quickly during crashes has to do with how options dealers manage their risk. Options dealers are large financial institutions that provide liquidity in the options market. When investors buy or sell options, dealers are often the ones taking the other side of the trade. But dealers usually don't want to bet on whether the market will go up or down. Their goal is simply to stay neutral. To do that, they constantly adjust their exposure by buying or selling the underlying stock or index. This process is called hedging. 2. A simple example of dealer hedging. Let's walk through a simple example. Imagine investors suddenly become worried about the market and begin buying put options for protection. A put option gives the buyer the right to sell a stock or an index at a certain price if the market falls. When investors buy those puts, someone has to sell them. In many cases, that seller is an options dealer. Now here's the important part. If the market falls, those put options become more valuable. That means the dealer now carries risk. So to protect themselves, the dealer may hedge by selling some of the underlying asset, like a stock index or ETF. If the market keeps falling, the dealer may need to sell even more to stay hedged. When large numbers of options are involved, this hedging activity can become very significant. 3. How negative gamma amplifies market moves. This is where the concept of gamma becomes important. Gamma measures how quickly an option's sensitivity to price changes. In simple terms, it tells us how aggressively dealers must adjust their hedges as prices move. During a negative gamma environment, dealers are forced to hedge in the same direction as the market. So when prices fall, dealers sell more. And if prices fall even further, dealers must sell even more. This creates a powerful feedback loop. Prices fall, dealers sell, prices fall further. That's one reason some market sell-offs appear sudden and almost vertical. The decline might begin with normal selling pressure, but dealer hedging can amplify the move and make it much more dramatic. 4. The snowball effect. A helpful way to understand this is to imagine a snowball rolling down a hill. At first, the snowball is small and moves slowly, but as it rolls downhill, it collects more snow and becomes larger. The bigger it becomes, the faster it moves. Soon the snowball begins moving almost on its own. Market declines during negative gamma environments can behave in a very similar way. At first, prices fall because investors are selling. But as dealers begin hedging their options exposure, that selling pressure increases. The decline begins accelerating. Just like the snowball rolling downhill, the market move starts gaining momentum. That's why some market corrections can feel sudden and chaotic. 5. Why market crashes eventually slow down. Fortunately, this process doesn't continue forever. Eventually, most investors who wanted protection have already bought it. Dealers have already hedged much of their exposure. At that stage, the mechanical selling pressure begins to fade. Markets may still feel uncertain. Headlines may still be negative. Volatility may still be high. But beneath the surface, the forces pushing prices downward may already be weakening. Professionals sometimes describe this transition as the gamma flip. When the gamma environment changes, dealer hedging can begin stabilizing markets rather than accelerating the decline. And this is often when markets begin forming the foundation for a recovery. 6. Why this matters for leaps investors. For short-term traders, Periods of extreme volatility can be very dangerous. Prices move quickly, emotions run high, and frequent stop losses can push traders out of positions before trends develop. But for investors using leaps, options that expire 1 to 2 years in the future, these environments can create a very different opportunity. During market crashes, prices often fall much faster than the long-term fundamentals change. If the broader market eventually recovers, long-dated options can benefit in several ways. First, the underlying asset may recover as selling pressure fades. Second, the option's delta increases, meaning it begins moving more closely with the underlying asset. And finally, volatility often declines after panic selling, which can stabilize option pricing. In simple terms, the same environment that feels the most uncomfortable emotionally can sometimes produce the most attractive long-term opportunities. 7. Structuring a leaps entry. When preparing for a long-term position during market turbulence, patience becomes extremely important. Many experienced investors prefer leaps with expirations 12 to 18 months in the future. This gives the trade enough time for the market to recover. Deep-in-the-money strike prices are also commonly used. These options tend to have higher delta, which means they move more closely with the underlying asset during a recovery. Instead of trying to perfectly time the bottom, investors often scale into positions gradually as volatility reaches extreme levels. This approach recognizes an important reality. Markets can remain unstable for some time before a new trend begins. 8. Final message. Market bottoms rarely feel comfortable. They usually appear when uncertainty is high and investor confidence is low. Negative gamma environments can accelerate market declines and make those moments feel even more uncomfortable. But beneath the surface, the forces driving that decline may already be approaching exhaustion. For investors who focus on long-term opportunities, these periods are not just moments of danger. They can also be moments of preparation. Because very often, the most powerful market trends begin when confidence feels the lowest. And for investors using leaps to participate in long-term growth, those moments of uncertainty can sometimes become the foundation for extraordinary opportunities. Thank you for watching and see you in the next video.